Welcome to Main Management's Weekly Market Note. I am Alex Varner, the head of research here at Main Management, alongside
Alex Dippery, the research analyst on the team here.
You're in good hands this week. The big thing up front is we have an advisory board update. Main Management has added Rusty Vanneman as our new chairman of the advisory board. He's got over 35 years of experience in the financial industry. We really look forward to working with him. We've known him for a long time. He is a speaker at our top advisor conference and really epitomizes our core values of client-first exceptional service. There's more available on our website, linked here, and as well on LinkedIn if you are curious and reading more about it. So welcome aboard, Rusty. We're excited to have you. Getting into the performance, this week was more up than down. We finished out the month of May on a strong note. May ended up 6.2%, I want to say, for the month for the S&P 500. We're now in the green, back for year to date. The week was pretty strong, up 1.1. And if you remember how choppy and volatile April was, this is a pretty remarkable recovery. I think if you ask people to take a bar bet on will we be back to break even by the end of May, the answer would have been a resounding no. So as you can see here, more sectors up than down. The international space continues to handily outpace the U.S. Euro Stoxx 50 up nearly 23% year to date. Developed markets up 17, emerging markets up 8. I read a funny stat actually that was frontier markets performed pretty well last week, I think, despite the liquidation of the only frontier markets ETF. So perfect timing on calling it there. But that's kind of the performance update for the week here. As we move on to the recession dashboard, a lot of blue across the bottom. As you can see, we're actually toying with moving some of these around potentially in June. Sentiment in particular could go to green, as we'll talk about in a bit. We're maybe seeing some signs of life. And on the PMI side as well, potentially seeing a move to green. This is open to interpretation, so don't hold us to that. And it is also, as we like to remind you, forward-looking. So this is kind of where things sit this is not necessarily indicative of where things sit now. We think it is where they're likely to go next. So it's important to keep this as the forward trajectory, not necessarily current. You can see that with employment. We don't think employment is in the red right now. It is chugging along, but it's red because we think it is more likely to deteriorate with the unemployment rate going higher, the monthly non-farm payrolls going lower than we think it is to improve. So that's kind of a little bit of perspective on that dashboard. On the data side, the big piece last week was the core PCE, that's personal consumption expenditures. That is the Fed's preferred inflation measure. It was up 0.12% month over month in April, which is basically in line with forecasts. That year-over-year figure, which is kind of that headline number that the Fed looks at, slowed to 2.52, which is the lowest since March of 2021. The kind of broader implications of this is it gives the Fed more leeway, more freedom when setting policy. They tend to hike rates when inflation is rising in an effort to combat it. And the concern here was that if we get inflation coming back on with the tariffs, and again, that is still potentially an issue down the road, but for now, we are seeing no signs of rising inflation, which means the Fed has a little more leeway to focus on the labor market on the kind of other side of their dual mandate.
Yeah, and this confirms a lot of what we've been talking about in previous weeks and months with the overall broader disinflationary trend.
Mm-hmm.
We'd had a few months of kind of choppier data, and throughout all that sort of stuck to that view that under the hood, the larger trend was disinflationary. So we're starting to see the resumption of that.
Yeah, and you saw as well, if you remember, this was in line. The CPI and PPI prints from April, which came out a couple weeks ago, were also below to in line. So that disinflationary trend is there. On the right side here, you can see spending, which decelerated. It posted a 0.23% month over month gain. That slowed. That's not a surprise. There was a lot of front running in March of the tariffs, people kind of getting out ahead and trying to buy stuff while they could before the price increases went in. And then since then, we've had postponement, on again, off again. But still, that uncertainty pulls behavior forward. If you don't know what's going to happen and you're thinking about a purchase, you're going to do it sooner rather than later. And why risk it, the price going up? But that spending is up 5.44% from a year ago. We'd like to point out that is still above pre-COVID levels. It's hard to see here, but that pre-COVID peak was 5.39. And we're at 5.44. So this has kind of settled nicely at above pre-COVID levels, despite some of the headlines kind of saying, "Oh, the consumer slowing, the spending is a concern." It's chugging along.
Yeah.
On the income side of things, incomes jumped unexpectedly. That's on the left side here, 0.82% month over month. That's the biggest monthly gain since January of 24. Year-over-year figures up 5.5, which is the highest since May of 24. This is nearly triple expectations for a 0.3% increase. And really, it was kind of driven by a 7% month-over-month increase in Social Security payments. Yeah. You can see on the right there are some components of the government transfer payments. That's like Medicare, Medicaid, Social Security, unemployment insurance. Social Security now year-over-year is up 17%, which is the most in 40 years, which is a little wild. But also part of that is a bigger base on the dollars as you're paying more people going into retirement. You would think that Social Security payments will go up. And on the we are seeing a little bit of an uptick in unemployment insurance, which does correspond directly with those weekly unemployment claims. You've seen those trend up, the continuing claims. So as people continue to file for unemployment, they will get unemployment insurance.
Right.
And that kind of makes sense. So this is something we do keep an eye on. But that unemployment insurance is up 4% year over year. And that's the most since July of 24. But on the left side, again, incomes accelerating while inflation is decelerating. That means people are getting more real purchasing power, which is a good thing. We also got Q1 GDP. The second estimate was revised slightly up. Still negative, but if you take away the decimal point, it went from 0.3 to 0.2. In reality, it went from 0.28 to 0.24, both negative readings. The components, again, this is a math equation here. Yep. Really, imports driving that negative reading relative to exports. Their imports were up 42%. Private domestic investment was up 22%, I think. Both were revised upward from that first reading. Concern here a little bit is the consumer spending and final sales were revised lower, which isn't great as they're about 70% of the economy. But again, as we saw with the April numbers, consumer spending, decelerated a little bit. And this is part of the tariff issue again, where there's weird distortions on the timing of these.
Yep.
And for what it's worth, Atlanta Fed is forecasting 3.8% for Q2 reading. Goldman Sachs is up at 3.5% for Q2. So this is you're going to see kind of a slingshot back as the math on these imports, exports kind of reverses itself in a way. And so the point being is a lot of the data I'm seeing, people are saying, hey, you're just going to want to take an average of Q1 and Q2.
Yeah.
Plain simple. Don't bother with Q1 by itself. Don't bother with Q2 by itself. Take the average of the two and you kind of smooth out the tariff effects. And that'll get you actually what the economy is doing.
Yeah. And that consumer spending, as you mentioned in the previous slide, should have a bit of a tailwind if incomes continue to rise. It's also, different from what we were hearing at the beginning of the year when people were concerned about a recession going into the year, and now you're averaging that Q1 and Q2, you're well into positive rates.
1.5-2% growth. This is pretty okay. Continuing on here, within that, as we mentioned, the consumer spending and final sales. Final sales number was down to 8. It was revised lower, and that's the biggest decline since COVID, which isn't great. But again, this is kind of the tariff timing, and the consumer spending on the left here revised down to 1.2 from 1.8. That's the smallest since Q2 of 23. But again, chugging along, you can see there on the left. Consumer spending is up every quarter, basically since Q2 of 2020 coming out of COVID, which is a good thing. And I think people kind of, perhaps underestimate the resilience, even if it is a little bit less, on the margins. The consumer is still chugging along here. We saw corporate profits as well as some of the inflation figures for Q1. And again, one of the nice things also about the Q1 data is it's all in the past. We know this. It's we've already lived through it. We're already we're 1 month away from the end of Q2 and we're getting Q1 data. So a lot of this has been kind of priced in real time and in the markets. But real core personal consumption expenditures, so again, that's real core PCE for Q1, were revised down to 3.4 from 3.46. So that's good on the inflation side. It is the highest reading in a year, as you can see there, but the downward revision is solid. And the corporate profits were down 3.6. That's reversing Q4's plus 6% jump basically. That's the biggest decline since Q4 of 2020. It is important to remember though, on an absolute basis, this is their second highest level ever. So this downtick is from the all-time high, and they're at $3.2 trillion and still up 5.1% year over year. So the corporate profits are, and as you can see, there's some decent noise in this number on a quarter to quarter basis. So it's not a huge thing to read into there. And the margins are still strong at like 15.7%. So they're doing okay for for the time being. Durable goods orders, excuse me, you see some more tariff distortions here with that big up in March and this big down in April. They were down 6.3, which was better than feared. Orders for core capital goods were down 1.3, and transports were up 0.2 of a year-over-year basis. Things are kind of moderating. They're slightly positive, which is just kind of chugging along, but they're coming still out of that. You can see that kind of slow uptrend acceleration on a year-over-year basis that started back in early mid 2023. So we'll see if this is maybe topping out a little bit here. Hopefully not. But again, there is certainly some chop in there. So again, we'll wait and see on the data. But basically, the report was kind of largely better than feared, helped by firmer than expected shipments of core goods, aircraft, and computers. Consumer confidence. So as we mentioned at the beginning with the recession dashboard here, we're looking at potentially changing this. The Conference Board's Consumer Confidence Index unexpectedly rebounded at 98, which is well above forecast for an 87 reading. The Expectations Index rose to 72.8, and the present situation was up to 135.9. That month-over-month jump in the Expectations Index of 17.4 points is the biggest monthly increase since 2009. So hopefully you're maybe seeing a little bit of sentiment turning here. This one is kind of, it's if you drew a ruler across it, being a steady downtrend. But again, it's still above 10, 11, 12 levels. Not to say those were phenomenal levels coming out of the GFC, but you got to start somewhere.
Yeah, and this was one that we were watching particularly closely because this is the first reading where you start to see some of the tariff alleviation news play in. Confidence had been something that was a concern before, and we were expecting that as this news starts to come in, as tariff concerns alleviate, you might see this reversal. So it's definitely very encouraging.
And that was kind of carried through here to the University of Michigan figure where we got that final reading, which was revised solidly upward, revised up to 52.2 from the preliminary reading of 50.8. So that was unchanged from April. And that was the first non-negative monthly move since December of 24. So that had been 5 straight months of negative moves. So even to just have a zero is again, you got to start somewhere. Consumer expectations were revised up to 47.9 from 46.5. That's the first month-over-month positive move since November of 24. And current conditions were revised up to 58.9 from 57.6, but those still tick down. Then you also saw on the other side of things, the one-year inflation expectations were revised down to 6.6 from 7.3. That's a pretty, that's like a 10% revision on the 1 year out expectations, and the 5 year down from 4.2 to 4.6. So they still have a ways to go until they've recovered to more normal historical levels. But the point is that, again, you got to start somewhere, and you're at least seeing maybe some turn in the negativity that's pervaded around the tariffs and the inflation story.
Right. Yeah, and that inflation really is the key thing to watch, because we had been slightly concerned about high expectations bleeding into actual inflation. And so to see that upward trend starting to abate is very encouraging. You're finally starting to see inflation expectations hopefully eventually come down to where inflation actually is. And so hopefully that spread will continue to close.
On the consumer sentiment side here for Michigan, they did the regression on this because if you look, post-COVID looks structurally lower than pre-COVID. And they were wondering why, and they saw that there has been a marked change in the number of responses and kind of the type of the responses, where they used to phone call people. So you'd speak with a human when you were responding. Now it's an online form. They are getting fewer respondents. So the response rate used to be 70-80%, call it. Now it's a fraction of that. It's half of that, 30 or 40% maybe. And also they noted that it's a lot easier to express negative sentiment to a text box than it is to another human on the phone.
Right.
And it's probably more likely that the people who are responding have a stronger opinion. If you're neutral and somebody sends you an email and they say, hey, fill out the form about how you feel about the economy, and you're kind of like, you might not fill it out. Right. Whereas if you're like, oh, things are really bad, like you're going to take the time and really lay into it. So they did a regression on it, kind of looking at the differences. And I think they came out with the delta is 9 points lower structurally than it used to be. So basically, it's take whatever number's reading now and add 9 to it, and that would be kind of more on par. So we are recognizing that, you take this with a grain of salt. As you can see, these responses change, and they can materially affect the way the sentiment plays out in the indexes.
Yeah, it's sort of similar logic as to why you don't see people leaving 3-star reviews on Yelp.
Yeah,
it's 1 or 5.
Yeah, exactly. Yeah. And even then, you're more likely to leave a 1-star review than a 5-star review. So 1-star reviews are driving the economy. Moving on. So in summary, as we said, core PCE in line. That year-over-year figure is the lowest since March of 2021. That's good. Incomes were up, so good real consumer spending power. Q1 GDP revised up slightly. Durable goods fell 6.3 month-over-month, beating forecasts. The report was largely better than feared. Sentiment indicators starting to show signs of life. Inflation expectations are slowing. And then out this week, we get the manufacturing and service PMIs first couple days this week. We get the job opening and labor turnover survey, which is probably the best acronym in government. The jolts there. We get trade balance and productivity. The trade balance will be pretty closely watched based on the tariff and the import-export pictures. Productivity will be for Q1. And then we get May non-farm payrolls, and that's probably the biggest data point on the week. And that's, I want to say, expected for a bit of a slowdown there on the monthly number. But again, not a material change kind of in the labor market that anybody is forecasting in this month.
Right.
So I think that's about it. Thank you for joining us, and we will see you next week.
Thank you.